Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Monday, March 23rd, 2009. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's still Standard Time in London, so it's 3:30 p.m. there. In Mexico City, it's 9:30 a.m. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. Some breaking reinsurance news. This has now been reported by Insurance Insider as well as Reinsurance Magazine. Founding CEO of Ironshore down in Bermuda, Bob Deutsch, is leaving the company. His position is going to be filled by Sean Kelly. He's leaving effective March 31st. This is yet another change that's happened as a result of Kevin Kelly coming in from Lexington. It seems to be a amicable split. The most recent release that came via Reinsurance Magazine has Mr. Deutsch saying that he's pleased to be moving on to other things and everything seems to be friendly. The stock market is up about 275 points already. There was some economic news this morning in the U.S. Sales of existing homes have reached its highest level now in 6 years. They were over 5% during last month's record. And then also, of course, Treasury Secretary Geithner released his toxic asset plan, which is being well received this time as compared to his previous effort back in February. Now to our main news. A Federal Express cargo plane smashed into the runway at Narita International Airport in Tokyo this morning. It burst into a ball of fire while attempting to land. It killed the two people on board, the American pilot and co-pilot. We've got some footage here taken by a security camera. Investigators believe that wind shear may have been a factor. The flight from Federal Express's hub in Guangzhou, China, appeared to bounce, as you'll see, after its initial touchdown. There you see it bouncing, and then it flips, coming to a fiery halt. The plane was an MD-11. Both the pilot and co-pilot were killed by the time the firefighters reached there. Investigators say that the accident may have been caused by low-level turbulence or wind shear, sudden gusts that can lift or smash an aircraft into the ground during landing. Unusually strong winds of up to about 47 miles per hour were blowing through Narita this morning. According to the Japanese Aviation Authority, the wind speed at the time of the accident was not enough to be considered dangerous. They say that there was a headwind of about 45 miles per hour, but the crosswind, which would be the key, was only 7 miles per hour. Last month, a flight from the Philippines was jolted by severe turbulence as it circled Narita. Prior to landing, it injured 50 people. This is undoubtedly bound to resurrect the slew of safety concerns that have been trailing around after the MD-11 for some time. The plane is no longer used by carriers for passenger travel, but it's widely used by Federal Express. It has been involved in accidents in the past in which it flipped while landing. In 1999, for example, an MD-11 flipped over and burst at Hong Kong's airport. And in 1997, another one landed and flipped while landing in Newark Airport in New Jersey. A former Japanese airline pilot, Tomoki Kawano, and he's also an aviation expert, said that the MD-11 does have a tendency to be unstable during landing. He said in the past the plane has a record of landing failure, and when that happens it flips over. Of course, the plane caused havoc at Narita. The two main runways were closed. Approximately 10,000 passengers have been affected. The wreckage is still burning on the scene apparently. And of course this has reinsurance ramifications in terms of cover. The global leader in terms of cover is Global Aerospace Underwriting Managers. Aon apparently broke the risk, and then the leader in London apparently is Catlin. The risk is insured, the hull is insured for about $65 million, it's understood. We have an interview that we recorded a few minutes ago with Richard Banks, who's the editor at the Insurance Daily magazine, the newspaper in London, and we'll play that now in its entirety. Today is Richard Banks, the editor of Insurance Day in London. Richard, are you with us?
I am indeed, Frank. Hello.
Good. Hello. Good morning for us. Good afternoon to you. Thank you for taking the time to speak with us today. Richard, I've been following your articles over the past few weeks talking about the ramping up of capital into Lloyd's And if I could maybe just go through the hit list, and this is drawn from an article that you ran on Friday under your byline. The total now we have that I've been able to count is Kiln with 125 million pounds of new money, Beasley 150 million pounds, Hardy's 40 million new pounds, Chaucer 75 million new pounds, Omega 130 million new pounds, and there's another one here for I guess 200 million new pounds. That's Catlin, and the total then is 720 million pounds, which is a little bit over 1.022 billion US. This is quite a reload, I would say. Would you not?
Absolutely. I think there are a number of reasons for this. Clearly, the exchange rate, foreign exchange situation is such that some of these companies are going to need a little bit more money in that. But at the same time, there's a real confidence in the Lloyd's market that the market is turning to such a degree that they want to be positioning themselves to take advantage and to have that capital there with which to address the rate rises that they're actually expecting to see.
Do you think that much of this, as you mentioned with the exchange rate, is due to the U.S. escrow trust funds that they're forced to put up?
Well, it's difficult to say at this stage. Certainly the claims aspect of it is going to be something that is forefront in their minds. Whether that particular issue is one that is going to be driving this, I don't know. I think it's probably unlikely. I think a lot of this is done through letters of credit, and so I'm not sure actually how much physical cash they have to put up for these things. Okay,
because I was going to say that I'm sure they're following that discussion over here about the collateralization requirements for quality reinsurers with the NAIC. So, I mean, presumably that would have an effect if they did, in fact, have to raise this money to escrow.
It's certainly true that they're following it very closely, and I think that there was celebrations at the end of last year when they felt at last that there were some moves being made. I think everybody is being realistic as to how quickly the situation is going to move forward, and being realistic as to actually how quickly it will be before any physical changes are felt. I mean, I think that it's fair to say that the new administration in Washington has got other things on its mind other than that particular aspect. But it's certainly true to say that there were some celebrations over here when the NAIC came out with its new framework.
Well, I agree with that. Just as an FYI, last night President Obama was interviewed on the CBS 60 Minutes Sunday night television show, and in the course of the interview, when you were talking about having other things on his mind, he said to the interviewer, he said, "Who would have thought a year ago that the Iraq War would be the last thing on my plate right now?" So that goes to show how some events can supersede what your best laid plans are. But let me ask you a question. One of the other points that have been coming up in your articles is not quite too articulated yet, but there, not that somebody like me at least was able to spot it. You're talking about a little bit of a contrast between the money that's being raised for capital markets type of alternative vehicles for reinsurance as compared to what seems to be an eagerness to throw more money at these traditional reinsurance vehicles, i.e. syndicates. And you had written an article back in mid-March, and I just want to pull this quote right out. It was from one of the sources in the article, in which you said it's not quite a zero correlation between cat bonds and other assets in the financial markets. This of course, is really a little bit of heresy, and the person who spoke this was actually somebody from the financial world, because the cat bonds had always been sold, or if you will, offered on this idea that they were completely uncorrelated in terms of risk. And that market has now, with some spectacular failures, seemed to have gone into a treading water kind of mode. How do you see the ease of capital for these two respective markets in the risk area?
In terms of traditional risk transfer and the cat bond.
Exactly.
Yeah. Well, I think it's fair to say we've seen with the score announcement a couple of weeks ago that there is some activity in the cat bond